A couple months ago, I sat down with a business owner. Great business, doing just under $1 million in revenue. He looked at me and said, "John, I feel like I'm making more than I've ever made, but I'm keeping less." So I asked him one question. "When do you make your tax decisions?" He said, "I don't. I just file my taxes." That right there is the gap. The tax law just went through one of the biggest structural shifts in the last 8 years, and most business owners are going to do exactly what they've always done. Wait until it's time to file. And by then, the outcome has already been decided. In this video, I want to walk you through 4 specific changes, but more importantly, the decisions that have to happen before the numbers ever hit the return, because that's where the money's made. And at the end, I'm going to give you a checklist you can screenshot and use to audit your own situation today. So stay with me for that. And just a quick note, everything here is educational, not personalized advice for your situation. Examples are hypothetical. For decisions specific to your numbers, work with your CPA, your attorney, and your financial planner. Let's get into it. QBI deduction is now permanent, and most owners still can't claim it. I'll stay with the same business owner for a moment. He says, "I keep hearing about this 20% deduction. My CPA said I don't qualify." And he's right, he didn't qualify, but not because he couldn't, because no one had ever positioned him to. And that's the pattern I keep seeing. In July 2025, the One Big Beautiful Bill Act was passed, the OBBA. It made the 20% qualified business income deduction permanent. That deduction was scheduled to expire at the end of 2025 and it didn't. That's genuinely good news for S Corp and pass-through business owners. But here's the part that matters more to you. For service businesses, think consulting, law firms, medicine, financial services, there's an income threshold. It's around $394,000 to about $550,000 of taxable income for married filing jointly. And that's indexed annually and it's subject to change, so you want to confirm those figures with your CPA. Once you're above that ceiling, the deduction doesn't just shrink gradually, it disappears entirely. And most business owners I work with are living right in that range, either not optimizing a partial deduction or sitting just above the line with no deduction at all. So let me give you a hypothetical. A consultant making $580,000 in a specific service-based business. He's above that ceiling. His business qualified income deduction is 0 because he's above the threshold. His CPA filed the return correctly. The return is correct and accurate, but nobody ever asked him what if he contributed to a retirement plan and pulled his taxable income back inside of that window. So if he went from $580,000 down to $400,000 by making a $180,000 contribution, now he becomes eligible again for a meaningful deduction on that remaining income. The exact math and the amount's going to depend on his full picture, of course, and his situation, which I work hand in hand with the CPA. We work through that to understand how the decision will impact him. But the point I want to make is that the deduction was already sitting there unclaimed. The planned contribution basically unlocked it. So the important thing is that the qualified business income deduction didn't get smaller. Your ability to claim it depends on whether your income and your retirement plan are structured to put you inside of that window. And that's the conversation most business owners have never had before. Which brings me to the change that tends to hit the hardest. What happens when you eventually sell? Capital gains in the exit window. I got a call from a different client. "Hey John, we just signed a letter of intent. Closing's in a couple weeks. Can you take a look at it?" And I already know what this conversation is going to be. It's not a planning conversation, it's a confirmation conversation. But I ask, did anyone walk you through what this looks like after taxes? He says, "Yeah, 20%. And I said, "Not exactly. The One Big Beautiful Bill Act made capital gains brackets permanent for 2026. 0% capital gains up to $96,000 for married filing jointly, 15% long-term capital gains if you're around that $600,000 level, married filing jointly, and 20% long-term capital gains for anything above that $600,000. That's also indexed annually, and that's also subject to change. But most business owners in that $500 to $1 million range are already sitting at or near close to that 20% rate before the sale even takes place. Then there's something most business owners don't hear about until they're at the closing table. It's called the net investment income tax, NIIT, and it's 3.8% surcharge that applies above $250,000 in modified adjusted gross income. That's for married filers filing jointly. And a business sale is typically going to trigger that. So the federal rate plus the net investment income tax is going to be roughly 23.8%. That's the real number. And you can see it on their faces, that moment where it shifts from, okay, I'll pay some tax to, wait, that's the number? By the time most owners hear it, there's nothing left to do. Now compare that to a different scenario. Same type of business, same type of sale, but start the conversation earlier. Now we can look at timing structure, whether spreading income across multiple years makes sense. So hypothetically, a business owner selling for $2 million in net gain, unplanned exit, everything hits in 1 year, 23.8% federal exposure plus state tax if any. Now, if it were a structured exit spread across multiple years, income may land in lower brackets each and every year. The after-tax difference can be meaningful, though the exact math will depend on the full picture. Installment sales have real trade-offs: buyer's risk, interest drag, deal complexity, and they're not the right situation for everybody. But they do need to be on the table before the decision made, not explained to someone afterwards. The exit window doesn't open the day you decide to sell it. It opens the day you start planning, and permanent brackets mean that planning can now cover years, not quarters. Now, after you've structured the exit, the next question is, what happens to what you've built after you're gone? And this one tends to surprise a lot of people. If this has you thinking, and you have questions that are better for a conversation than a comment below, there's a link below to set up a 20-minute chat. Let's get back into it. The estate exemption is now $15 million, but here's what that still won't protect. So I'm sitting with a couple and they say, we're good, right? The estate tax exemption is $15 million. And I said, it might be, but that's not the real risk. The one big, beautiful bill raised the federal estate and gift tax exemptions to $15 million per individual in 2026. That's also indexed for inflation going forward and made it permanent. So for a married couple, that's $30 million that's sheltered. The clawback risk that estate planners had been worried about for years, that's all gone. But $15 million doesn't protect everything. And the two things it doesn't protect are the ones that quietly create the real problems. The first one is the state tax. The federal exemption is $15 million, but state exemptions are not. For instance, Massachusetts has an exemption of $2 million. Oregon has an exemption of $1 million. And a business owner who's living in New York City with $1 million estate could owe meaningful state tax with zero federal tax exposure. So geography matters more than most people realize. Second, and this one's the one that tends to land the hardest, it's liquidity. Hypothetically, a business owner with a $12 million estate, no federal tax exposure, but 90% of that is tied up in the business. Now, at passing, the family has to settle the estate. If heirs need the cash and the business has to be divided or sold or whatever process it's got to go through, there could be a forced sale at the wrong moment to the wrong buyer at the wrong price. And that's the outcome that no one really plans for. Now, life insurance inside of an irrevocable trust is often the cleanest option to solve that liquidity issue. And it's typically a very good solution for this gap, but it's the protection conversation most business owners haven't had, even when estate tax itself isn't their problem. And one of the places that liquidity gaps show up, sometimes without owners even realizing it, is in their retirement accounts. They built them up for decades, but then what happens when they pass? Inherited IRAs and the 10-year rule that's going to hit your family. I had someone say to me recently, my kids would just take the money when they need it. And I had to walk them through what that actually means now. Because most people don't know that the rules for inherited IRAs change with the Secure Act 2. Your kids no longer have the ability to stretch that money out over their lifetime. They must take the money out over a 10-year period. And understanding how the Secure Act 2 will affect how your beneficiaries can take money out of your qualified plans in your IRAs is one of the best planning tools that you can start looking into now. As of 2025, the IRS finalized this, and it applies today. If the original account owner has already started taking required minimum distributions before they had passed, the beneficiary must take annual distributions throughout those 10 years and empty the account by year 10. Every year, on a schedule, stacking on top of whatever else they've got going on in income. So hypothetically, a business owner leaves $1.5 million traditional IRA to a 50-year-old child in their peak earning years. Now they're adding $150,000 of taxable income or more per year in required distributions on top of what other income they might have. That's every single year for 10 years. Now that income doesn't go into a separate favorable bucket, it stacks directly into their tax bracket. And that compression is significant, and it's largely unavoidable unless the original owner plans ahead. There are things that the original owner can do now. One's called a Roth conversion. If the account owner converts traditional IRA dollars to Roth while they're alive, paying the tax now, distributions from an inherited Roth IRA may come out income tax free depending on how the account was structured and how long it's been held. It's worth noting that conversion increases taxable income in the year it happens. So it's not the right move for every situation, and the timing does matter considerably. With the One Big Beautiful Bill Act making brackets permanent, that multi-year conversion math is now plannable with real certainty. What matters is that the decision happens intentionally, not after the fact. A traditional IRA left to a child in their peak earnings isn't just a gift, it's a compressed 10-year tax bill. The owner who plans for this now can change what that inheritance actually looks like. Quick question, of these four, which one made you stop for a second? Drop it in the comments below, I read all of them. Was it 1, 2, 3, or 4? So here's what I've noticed after doing this for a long time. None of these problems show up on their own. They show up because one conversation happened with your CPA, another with the attorney, another with the financial advisor, and nobody tied it together into one coordinated picture. The way I describe my role to clients, I'm their personal CFO. I'm not replacing their CPA. I'm not replacing the attorney. What I do is I sit in the center of those relationships, making sure the tax plan, the legal structure, the financial plan are all working from the same picture at the same time. That's the CFO role. Not preparation, but coordination. And our planning is built around 3 core pillars, and they're actually what define our company name, TriBox. We help clients think through cash flow. We help them protect and grow what they built. And when those 2 foundations are in place, they can approach investment decisions from a position of clarity rather than pressure. Cash, protection, and investments. That's the model. Most business owners think taxes are something you deal with once a year. They're not. They're the results of decisions you made months, sometimes years earlier. And once you see it that way, you stop asking, what do I owe? And you start asking something different. What should I be doing right now to change the outcome later? And that's what every chapter in this video was really about. And before I let you go, here's the checklist that I promised you. Take a screenshot of this. If this sparked questions and you want to connect about them, reach out using the link below. Set up a 20-minute chat. I'm here to help, whether it makes sense for us to work further or not. I enjoy these conversations and I appreciate you watching. And if you want to go deeper on the retirement plan vehicles we touched on in chapter 1, the solo 401k and the cash balance combination can pull income inside that qualified business income window that we talked about, and that video is linked right here. I'm John Rojas. I'll see you on the next one.